Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Happy 2026. I'm recording this on January 11th. Went to bed last night. The Green Bay Packers were up 21-3. Woke up and they'd lost. But I'm a Viking fan, so I don't care if the Bears or Packers won that game as long as they lose the next game. All right, that one's for Todd. But it is 2026. Again, recording this January 11th. 2 days ago was Friday, January 9th, also known as the second Friday of January, also known as Quitter's Day. So I haven't quit my New Year's resolutions yet. I hope that yours are still on track. And while I'm trying to look at social media less as one of my New Year's resolutions, I did see something yesterday that made me want to do a podcast today, and that was from President Donald Trump, who said on the White House press release, and also I saw it on X, aka Twitter. It says, please be informed that we will no longer let the American public be, quote, ripped off, unquote, by credit card companies that are charging interest rates of 20 to 30% and even more, which festered unimpeded during the sleepy Joe Biden administration. Affordability, all in caps, exclamation point. And then highlighted in yellow, effective January 20th, 2026, I, as President of the United States, am calling for a one-year cap on credit card interest rates of 10%. Coincidentally, the January 20th date will coincide with the one-year anniversary of the historic and very successful Trump administration. Thank you for your attention to this matter. Make America great again, President Donald J. Trump. I'm not going to get into the politics of all that, although calling for is different than implementing. And why is that? Because he really doesn't have the authority or the power. But this action would have many unintended consequences. And this morning, got up and looked at my Wall Street Journal. There has an article on it titled "Trump calls for 10% cap on credit card interest rates," with a subheader of previous proposals to cap interest rates haven't gained much traction in Congress. And then on my Bloomberg subscription, the title of the article is "Trump's call for 10% credit card cap aims at banks' crown jewels." And anyway, that article was a little bit better, had a little bit more depth to it. And then I put some thoughts together from those two and my general thoughts on how this could impact credit unions for the podcast that I have for you today. So again, what does it really mean when President Trump is calling for a 10% credit card cap? Why is he doing it? And again, what are the parameters of what he's saying? He's saying a one-year 10% cap on credit card interest rates. The articles point out that the average card APR today is 21%. By the way, obviously, if you're a federal credit union in particular, you know that the Federal Credit Union Act caps rates at 18%, caps it at lower than its 2A has to renew the 18%, but it is capped at 18%. So credit union members, by definition, already get a better rate at the max than is the average elsewhere. Something that makes me proud to be in the credit union industry and the movement. So this targets one of the most profitable products in banking, although for credit unions, it's probably not as profitable as it is for the big banks, just because of the volume and the challenges of having a huge, big program like that. Similarly, they can do a lot more with their program than a lot of credit unions do, and a lot of credit unions have sold their portfolios. But it's a politically popular message. Why? Because it helps consumers who are, quote unquote, drowning in interest. But is it financially and operationally doable? Well, that would be very complicated. So as a primer, why are credit cards so profitable? Credit cards obviously are unsecured debt. There's no house, no car to repossess. Charge-off rates are historically much higher than mortgages. Post-crisis cards, charge-off rates are 10% versus mortgages, which are substantially lower than that. Banks and credit unions price in defaults, they price in fraud, they price in reward programs, they price in servicing and compliance costs. And as you see, as we layer on, as you know better than I, as you layer on all the things that you have to factor into the costs, it becomes very difficult to make money at a 10% limit. Now, an example would be JP Morgan's card portfolio. Data I pulled off the web, so must be accurate, right? Maybe it's accurate, but JP Morgan's card portfolio, roughly $200 billion in loans. Their net yield after everything is 9.7%. They off of $25 billion in revenues. And oh, by the way, they charge off $7 billion. So there is a margin, and it's not all profit if you go at 10%. So that's where the misnomer is. That's where this is more of a political, yeah, it would be great. I'll throw this thought out there so people think that I'm doing something good for them, which is my take on what President Trump is doing. Do I think it will happen? No. Do I think he thinks it will happen? No. Is he just making a headline? Yes. But let's walk through the whys of this not making sense. Now, the other challenge is if such a cap was going to go in place, you'd see credit tightening, you'd see fewer approvals, you'd see lower credit limits, so smaller loans to everybody or to most everybody, closure of riskier accounts, and Fed data estimates that 14.3 million people could lose access to credit. Again, these are from the articles. 14.3 million people could lose access to credit if this went into place. There would be a re-engineering of products, right? So there'd be higher minimum payments, there'd be fewer grace periods, fewer promotional 0% offers. So every action has a reaction, and all these other things, theoretically, if a 10% cap was to go into place, these other things could come into play. Credit card rewards would get cut. I'm a big fan of credit card rewards. Cards I'm loyal to, I really enjoy getting the perks, whether that's for flying, whether that's for gift cards for restaurants, whether that's for, discounts at other organizations, et cetera, et cetera. A 10% cap doesn't leave a lot of leeway for the funding of rewards programs. So, and again, it would be those low income, middle income people would be hit higher than the people at the other end of the spectrum. And it also then would impact the profits because the people at the higher income levels pay off their loans, and it gets into more of an interchange income thing than making money off the interest. So who could get hit the hardest? Not all lenders would be impacted evenly. Some banks do more than others. Some credit unions do more than others. You've got Capital One, you've got Synchrony, which is store cards. Those could be impacted big. Least affected would be prime borrowers, high-end consumers, and people who pay their balances in every month. Now, the irony, oftentimes when you see people taking actions that you think will help people on the lower income spectrum, it has the exact opposite. And the reality is that this is supposed to help those folks, and they're the ones most likely to lose access to credit if such an action were to come into play. Now, another unintended consequence would be the payday loan program problem. If mainstream credit dries up, consumers don't stop needing money. They shift their requests, their desire to go get those loans to payday lenders, to pawn shops, to rent to own, and that's not good for anybody. So the policy trade-off becomes, is a 10% card cap better than someone moving into vastly more expensive alternatives? Which can range up to 300% for some of those programs that I mentioned there. So the reality is there is no free lunch, and the 10% cap would cause far more problems than it might create. So the political and regulatory reality check, how could this even be implemented? Congress has debated this for years. Sanders and AOC have proposed a 15% cap. Sanders and Hawley have proposed a 10% cap. None of these have passed. The Trump tool set right now is public pressure, regulatory persuasion, but not a clear statutory authority. As I said, credit unions under the Federal Credit Union Act can go up to whatever NCUA approves up to 18%, and it's been 18% since at least 1986 when I started in the credit union industry. So banks are also simultaneously seeing capital rules ease, stress tests softened, and a general deregulatory posture overall, which is what credit unions are also seeing. Those things are pro-bank, and this credit card movement would be anti-bank or credit union. Now, the challenge that credit unions would have, and I saw in an email that America's Credit Unions is doing a conference call on this tomorrow, but they've already come out and called a 10% cap devastating. Many credit unions couldn't offer cards at that rate at all. I'm sure some of you listening might actually offer that to your top end people, and that's great. And it will ultimately, in their opinion, force some credit unions out of the card business, and they'll have members pushed to non-regulated lenders. So it's not just an issue of Wall Street; it's a Main Street issue. Now, what theoretically could help consumers if the goal is affordability without killing access? Some would argue that there'd be some consumer compliance type things that could be done, better disclosures, et cetera. I wouldn't go down that rabbit hole. So the big picture takeaway on this is the proposal taps into a real frustration. People hate paying 20% and balances that are at a record level. But blunt tools create blunt damage. There'd be less access, there'd be higher fees, there'd be fewer choices, there'd be more fringe lending. And while it's good politics and it's good headlines, it's dangerous to be contemplating putting this in place because it would, again, have many unintended consequences. So that's my take on the 10% Trump desire to change rates. I'm looking forward to some exciting episodes we've got coming up. As I said, this is January 11th. This past Thursday, had NCUA been planning a board meeting this coming Thursday, they would have had to announce what the agenda was. And I did not see that come out in my emails. I did not see it on their website. So they're skipping a January meeting. And as they did last year, with only one board member, with not a lot of regulatory desire from the administration and from board chairman Kyle Hauptman, they're just skipping this board meeting. I am hearing rumblings that NCUA has told their staff that there's material changes coming to the structure of NCUA, possibly to the dissolving the Office of National Exam and Supervision, possibly dissolving some other offices that will ultimately impact credit union. I'm really looking forward to when NCUA is going to be transparent about this and tell the industry about it. They just deserve the right to do that. These things should be done in the sunshine, and the fact that it's being talked about in NCUA, it should be talked about in the public. But they're not having a board meeting this week, so don't expect it in January, possibly in February. Maybe there'll be some big reveal before they go to the America's Credit Union's GAC. I'm planning on going to GAC again this year as a member of the press for the podcast. So if you go there and want to catch up, you let me know. And again, 2026, hard to believe we're in the second week of it. Very excited to have this first episode of the year up and running, and we'll see you again here soon. As always, I want to thank you for watching. Thank you for listening. This is Mark Treichel signing off with Flying Colors.